Welcome to qiphyedu. Today I'll be looking at Economics A2 level, Paper 31 or Paper 33 because both the papers are the same, May, June 2023. Alright, let's start. Okay, so for the first question it says, what does the marginal utility diagram show? Okay, so you can see here, this is a marginal utility diagram. And then this basically the meaning of marginal utility is the additional utility gained from consuming an additional unit of a good. So you can see here, let's say we start from X. So if we start from X, quantity X, you realize that the marginal utility that you're getting is around this point. Alright, and then when you consume until quantity Y, not like it's a larger number, the marginal utility you're getting is 0. So that means it's dropping. And then after you consume from quantity Y to quantity Z, you get your marginal utility line in the negative area of the y-axis, which means that the marginal utility changes from a positive number to a negative number. And why is this the case? The reason for that is if you consume more and more goods, the same good, if you consume more and more of the same good, your satisfaction will decrease. It's like, let's say for example, you have, let's say 10 bars of chocolate. Maybe you haven't eaten chocolates in a long time, so you decided to have, let's say, 1 bar of chocolate, and you are satisfied with that 1 bar of chocolate because for one, you haven't eaten in a long time, and second, it tastes delicious. But if you eat more and more of the same bar of chocolate every time, you'll realize that first of all, you don't feel as satisfied as before. Second, you would refrain from eating that chocolate anymore. Number 3, you're probably already full at this point, let's say. So that's why the marginal utility will decrease. It will change from a positive number to a negative number, and at the same time your total utility would also start to decline after your marginal utility reaches the negative part of the y-axis. So if you look at the 4 options here, A, it says total utility becomes negative if the quantity consumed increases from Y to Z. Total utility will not become negative if the quantity consumed increases from Y to Z. Why? Because if you combine every single marginal utility on this line, and then you include or you plus the marginal utility you gain from Y to Z, it's not enough to change this entire thing to a negative number. Let's say for example, the entire thing here, let's say it's the total utility getting from consuming quantity Y is 500. From Y to Z, you're getting, let's say, negative 100. So if you take 500 and you plus negative 100, for example, you'll get 400, which means that the number is still a positive number. So the answer cannot be A. Because the number is too small, the quantity is too small to justify that the total utility would change from a positive number to a negative number. It will still remain a positive number. And B, total utility decreases if the quantity consumed increases from X to Y, which is incorrect. I'll explain why. Like what I mentioned in the beginning, if you look from, let's say if you start from quantity X, you get utility of this number, which is a positive number, and then if you look at Y, you get a utility of 0. But total utility decreases. This phrase means that the number will then drop. So you can see here, let's say for example, I'm just going to take some random number from, let's say, quantity beside X. Let's say for example the utility here is, let's say, 50 for example. If I consume quantity X, my marginal utility would be 30. Let's say I take a quantity on the right of X, let's say it's 10. So if I add it up together, I'll get 90, right? I'll get 90. If let's say I consume something more than this line, let's say here, let's say it's 5, then I'll get a total of 95. So the total utility doesn't decrease, it actually increases, but at a declining rate. Total utility will only decrease if, let's say, you are entering a zone where the quantity that you consume resulted in a negative margin utility, like what I mentioned here for y to z. Your margin utility would be negative. And only then the total utility would decrease. And in that case, right, the total utility decreases if the quantity consumed increases from y to z instead of x to y, because like what I mentioned, for the quantity x to y, the margin utility line is still on the positive part of the y-axis, and then from y to z, it's on the negative part of the y-axis. Therefore, B is not an answer. If you look at C, it says total utility decreases if the quantity consumed increases from y to z. Okay, so this would be correct because like what I mentioned, total utility decreases if the quantity consumed increases from y to z because the margin utility will now become a negative number. So the total utility which will gain you a maximum total utility would have to be at point y, because your margin utility at that point would be 0. So if you enter a territory where y to z would now result in a negative margin utility, your total utility would now decrease. Say for example, the total utility for the entire quantity where you consume until quantity y would be 600. If you enter quantity z, you result in a negative margin utility of, let's say, 100. So then if you add up negative 100, you'll get 600 minus 100, you get 500, which means that your total utility would indeed decrease. Therefore, answer will be C. Now let's look at why D is wrong. D says total utility is maximized at X. Okay, you need to remember that, like what I mentioned just now, total utility is maximized at the point where the margin utility equals to 0. If, let's say, total utility is maximized at X, X would have to be 0. But you can see here, for X, the utility that you're getting is still this number, which is a positive number. You want to add up the entire positive total utility. So when you add up everything, it has to be the entire utility from 0 until y, because after y, the number will be a negative number, which means that the total utility will drop. So the peak where the total utility would be at its highest would have to be when the margin utility will no longer go up. Instead, it will be before the total utility goes down. It's like this curved bell-shaped graph, for example. So this is at a point where where the quantity equals to 0. So this is where you get the highest total utility, right? So that's why D is not the answer. Instead, it has to be Y, because if it's X, then your total utility would need to be like something like at this position. All right, so answer will be C. Okay, question 2. The initial allocation of goods between 3 consumers is shown. Consumer 1 consumes 2, consumer 2 is basically 5, and consumer 3 is 10, and then the total would be 17. So, which rule shows a Pareto improvement in the allocation of goods between consumers? So Pareto, or in this case Pareto optimality, means that a person would be made better off without making someone else worse off, which also means that this thing here, it means that if you were to be able to consume more of that good, the other person would then not consume less of it. Let's say, for example, both of you have 5 bars of chocolate. Now, because of allocative efficiency, you end up having 6 bars of chocolate, but then the other person only has 4 bars of chocolate. So this is not Pareto optimality or Pareto improvement. If let's say there's Pareto improvement, it has to be when the person consumes, let's say same thing again, 5 bars of chocolate, both of you. You get 6 bars of chocolate, the other person gets 5 bars of chocolate. There's a Pareto improvement because the other person is not made worse off by having less bars of chocolate. Same goes if, let's say, 5 bars of chocolate for one person and 5 bars of chocolate for another person, and after allocative efficiency, both people get 6 bars of chocolate each. That is also Pareto improvement. So the point here is that if one person has an additional bar of chocolate, the other person would not be getting less of that particular same product. Alright, so here let's look at which one shows Pareto improvement. So the key here is that you need to make sure that all the numbers that we are looking at here, at this area, would have to be either the same or more. Cannot be less, because if it's less, then there's no Pareto improvement for each consumer, for any one of the consumers. So if you look at A, here, you can see that for consumer 1, it's the same amount, and then for consumer 2, it's also the same amount. For consumer 3, there's an improvement, so total is 18. So A would be correct, but let's look at the other 3 options. So for B, you can see consumer 1 consumes 4 of that good, consumer 2 consumes the same, but there's a drop from 10 to 9 for consumer 3, therefore B is incorrect. Now for C, consumer 1 consumes from 2 to 4, and then for consumer 2, there's a drop from 5 to 4, therefore answer is not C. Consumer 3 is the same, so yeah, so for this one, it's a drop from 5 to 4 for consumer 2, so that's why there's no Pareto improvement. Because like what I mentioned, if let's say you want someone else to improve, you cannot make somebody else worse off from that particular allocation. And for D, consumer 1 would have to be, there's an improvement from 2 to 6, for consumer 2 it's 5 to 6, and for consumer 3 there's a drop from 10 to 6, therefore D is incorrect. So the only row that shows a Pareto improvement would have to be A, because as you can see, consumer 1 and 2 have the same amount of goods, while consumer 3 has gained 1 more. In total is 18, so answer is A. Question 3, which assumption in relation to an indifference theory diagram is not correct? So an indifference theory diagram is basically when, if you look at this graph here, this is your budget line and this is your indifference curve. Okay, so for an indifference curve, it's basically the maximum combination of 2 goods that will provide equal utility to a person for consuming those 2 goods. So you need to remember that for indifference theory diagram, there are 2 things that may happen. One is substitution effect and second is income effect. So basically income effect is, it will occur depending on whether or not you have an increase in salary or decrease in salary. And then substitution effect is basically when the good itself is normal good or inferior good or given good, which will be also affected because of changes in salary as well. So if you look at the 4 options here, A says the consumer's income may change. Like what I mentioned just now, income effect does actually cause that to happen, will actually result in income effect, so A would be correct. B, it says the consumer may change their satisfaction maximizing objective, which is incorrect, because first of all, we have to assume that for the indifference theory diagram, we are getting maximum combination of 2 goods that will provide equal utility. So they will still maximize their satisfaction, which depends on their salary or income in this case, and also depending on the price of the 2 goods. So the objective is there, it's still constant, so B is incorrect. C says the consumers may change their taste and preferences. Consumers' taste and preference will change over time. Maybe they like apples, but later they don't like apples, they prefer oranges instead. Then yes, the consumers may change their taste and preferences. And D says the relative prices of products may change. This is correct because, like what I mentioned just now, maximum combination of 2 goods based on that will provide equal utility to the consumer based on the price and also the income of the consumer. So the prices may change, and it will also result in a change in the budget line and also the position of the indifference curve. Therefore, answer will have to be B. Question 4, which type of efficiency is shown by the shift from long run average cost curve 1 to long run average cost curve 2? So you can see here the long run average cost curve 1 has been shifted downwards. Shifted downwards as in the price has decreased. So what will result in this would have to be a change in technology, which would result in an increased production of the good. So this one would have to be dynamic efficiency, because as you can see here, it says long run average cost curve, which means that this happens in the long run. So it's only when you purchase a lot of technological machines, a lot of new machines that would increase the production of the goods, and then over a period of a few years, for example, that will only reduce the price by actually being able to produce more of the same goods and then it will also decrease the price due to the market mechanism. Therefore, it has to be dynamic efficiency. You need to remember that there is no Pareto efficiency in the economics A2 level textbook. It's either dynamic, allocative, or productive efficiency. Now, the reason why it is not productive efficiency is because there is still a limit as to whether the person can produce a lot of the products at that time. Like, because for example, productive efficiency will only be able to tackle compared to dynamic efficiency. Productive is mostly compared to dynamic efficiency. Dynamic because of the fact that it's because of technological changes, whereas productive efficiency is more on workers and their efficiency in general, which would only be more effective when it comes to the short run. And then for dynamic efficiency, because it's technological processes, therefore it would be the long run, because only over time you'll be able to break even and earn from your investment in the machines, and also result in a decrease in the average cost. Allocated efficiency is basically when you are adjusting to where the price equals the marginal cost, and that one has nothing to do with dynamic or productive. There's a difference between that and also dynamic and productive efficiency in this case when it comes to the fact that this one is efficiency because of production. Alright, so answer is B. Okay, question 5. A firm wishes to maximize its revenue, and which condition must be met to achieve this goal? Okay, so basically, let's just draw a graph and then I'll explain. So this one would be your MR curve. So basically the additional revenue gain from producing the revenue gain from producing an additional unit of a good, and then your average revenue curve, where the total revenue would then be divided by your quantity. And then this one would be your MC curve, and then this one would be your AC curve. AC curve meaning average cost, MC curve meaning marginal cost. Okay, so which condition must be met to achieve revenue maximization? So if you remember, or if you recall from the economics textbook, for profit maximization, it has to be at the point where MC equals to MR. Okay, so MC equals to MR would be at this point, because you can see here, the total area that you earn would be the highest, the total earnings you earn would be the highest. Okay, so that's because that's basically when you earn the most out of your products. So that's profit maximization. But here you can see we're not talking about profit maximization, we're talking about revenue maximization. So revenue maximization would be basically the maximum amount that I can earn from this sale, sale of products. So that's basically not the answer. So MC equals to MR is not the answer. But let's look at AC equals to AR. Okay, if it's AC equals to AR, it will be at this point. And if you realize at this point, your MC curve is above the AC curve, and you'll see that if you go anywhere more than AC equals to AR, let's say for example this position, you realize that your revenue will be lower than your cost, which also means that you're incurring a loss. So AC equals to AI is you only work when you are trying to break even. If you're not trying to earn anything, then AC equals to AI is where you break even, but it's not where you're basically maximizing revenue. Instead, in this case, it's called sales revenue maximization. So this is also not the answer. Okay, so now let's look at marginal cost equals to average revenue. So you can see here, marginal cost equals to average revenue is at this point. But marginal cost equals to average revenue is not the answer, because here we are trying to maximize revenue. So if you want to maximize revenue, if you remember from the previous, the first question when we talked about total marginal utility, you need to remember that the total utility would be at the peak when the marginal utility equals to 0. So if you go anything more than that, you end up with a marginal revenue value that is negative, which also means that you'll be decreasing your revenue. And in this case, in order to maximize your revenue, your marginal revenue would have to be 0, because like what I mentioned, it will be at the peak, right? So that would be the highest point, because at that point your maximum, your revenue would then stop increasing when it will start to decrease because of limited machines, limited manpower. Basically that's how it will result in a decrease in revenue. So to maximize revenue, your marginal revenue would have to be 0, which means the answer is D. Right? Question 6, the cost and revenue of 4 firms operating in a monopolistically competitive market are shown, and which firms will continue to operate in the short run but will shut down in the long run. Okay, so total fixed cost is basically cost that cannot be changed. So you can see here, it's 10, 50, 300, and 100 each for W, X, Y, Z. And then total variable cost will be 20, 40, 300, and 600. So in this case, you see here that for total variable costs, it will be 20, 40, 300, and 600. So now it's asking you which firm will continue to operate in the short run but will shut down in the long run. If let's say your total variable cost is higher than your total fixed cost, then you don't have to worry about actually shutting down in the long run, because first of all, in the long run, you can control your variable costs. At the moment, maybe you can't you can't avoid the variable cost, but then in the future, you could theoretically fire staff, for example, which will result in a decrease in variable cost. Maybe you can cut costs on many things, including expenses that may or may not contribute to your business. And in this case, you can see here, your total variable cost is much, much higher than your total fixed cost, as we're talking about Z at the moment. So in the long run, you'll be able to operate because you can control your variable costs, which is higher than your fixed costs. But if you look at let's say if you look at firm Y, for example, you'll realize that the total variable cost and the total fixed cost are the same, which is 300 and 300. In this case, right, your fixed cost is at 300 and your variable cost is also at 300. So in the future, if you were to control your variable cost, you could control your variable cost, but then your fixed cost is also relatively high and your revenue is only at 500. So in this case, right, Y would shut down in the long run because the variable cost is high and the fixed cost is also high. Okay, whereas in this case, both of them are the same. And then for X, your total variable cost is lower than your total fixed cost, which also means that if your fixed cost is higher than your variable cost, it's very difficult for you to control your variable cost in the long run. And in this case, it may also shut down in the long run. If you look at W, your total variable cost is at 20 million, where your total fixed cost is at 10 million, and total revenue is 15. You can control your variable cost because, like what I mentioned just now, your variable cost is higher than your fixed cost. And in this case, W and Z will operate in the long run, but for X and Y, the answer is no. So answer is B. Question 7, a firm at its current level of production finds that its short-run marginal cost is less than its short-run average variable cost, and which conclusion about the firm can be drawn from this information? So its short-run marginal cost is less than its short-run average variable cost, which means that your if you look at this curve, let me see, MC curve, and this one is your ABC curve. Okay, so its short-run marginal cost is less than its short-run average variable cost. So you'll only incur at the point where it's dropping, right? The ABC is dropping. But if let's say your short-run marginal cost, I didn't put SR, but yeah, that's what it is. If your short-run marginal cost is more than your short-run average variable cost, that means that both of them are increasing. But if let's say your short-run marginal cost is less than its short-run average variable cost, both of them may be decreasing, or the marginal cost may be increasing. but then your marginal cost will still be lower than your average variable cost. And then your average variable cost would definitely be falling, because the MC curve would only intersect the ABC curve at the lowest point of the ABC curve. Okay, so A, it says average variable cost is constant, which is not correct because constant means this. So no. B, it says average variable cost is falling, which is correct because like I mentioned, it is dropping. It will only intersect, the MC curve will only intersect the ABC curve at the bottommost point of the ABC curve. C, it says average variable cost is greater than its average total cost, which is incorrect. Your average total cost would have to be higher than your average variable cost. And then it says average variable cost is rising, which is incorrect because like I mentioned, if let's say the average variable cost is rising, your MC curve will have to be higher than your ABC curve, which is shown on this diagram here. So answer is B. Question 8. Steel producer X takes over its main competitor, steel producer Y. What would X expect to happen to the price elasticity of demand for its product and its long-run average cost as a result of this takeover? So when you decide to take over a company, let's say in this case it's duopoly, or in this case oligopoly because duopoly doesn't exist in the A2 textbook. So two companies end up being only one company, meaning monopoly. So your price elasticity of demand would then become inelastic because everyone would end up having to buy from you instead of buying from other companies because there's no other alternative. So let's say, for example, let's take train service for example. Train service in Malaysia, that is for long haul train services from, let's say, the northern point of Malaysia to the southern point of Malaysia is operated by KTM. You only have KTM as your only choice for rail transport, so you have to rely on it regardless if you really need rail transport. So your price elasticity of demand would decrease, and then your average cost would then decrease because you bought over the company, which means that you have more machinery to deal with, you can produce more, you have more infrastructure, so you don't have to pay to actually operate more, to operate the only things that you have at the moment. So both of them will decrease. So answer is A. Question 9, what is an example of an external cost? External cost is basically the cost that is incurred outside of production. So A, it says distribution cost, which is considered internal cost. Energy cost is also an internal cost. Labor cost is also an internal cost. Because internal cost takes into factor your production, what would result in costs when it's producing something, that will be internal cost. Your distribution cost is an internal cost. Your energy cost is an internal cost because you need energy to operate machines, electricity, all these things, and you need to pay labor costs, which means that you need to pay your workers money to do products. So that's an internal cost. Road congestion cost is an external cost because it happens outside of the company. So outside the factory, which is unavoidable or avoidable depending on the situation. So that itself is indeed an external cost because it happens on the road, which is not under the jurisdiction of the factory. So answer is D. Question 10, the diagram shows the demand for and supply of a good and the marginal social cost for that good. Assuming there are no external benefits, which area measures the net social benefit and output or Q? Okay, so you can see here that for the entirety of X, you see that the marginal social cost and the marginal social benefit, they basically in this case, right, your marginal private cost, in this case, right, your X here would then have to be the total benefit. But if let's say you were to produce IQ, you realize that your marginal social cost is higher than your marginal private cost. Although it's not listed here, your marginal private cost is actually lower than your marginal social cost. Okay, so in this case, in order to calculate the net social benefit, your net social benefit would have to be the entirety of X, which is MSB, the demand curve, equals MPB, alright, and then you have to minus Y, because if let's say we're not producing at OQ, we're producing at a point where MSC equals to MSB, your entirety of your MSB would be the entire thing below the demand curve. which is this thing. However, because of the fact that there is the existence of MSC, you need to minus MSC, which means that the entirety would only have to be X, which is this thing here. Now we're producing over MSC equals to MSB at point OQ, which also includes the area of Y. And you can already see that for Y, your MSC is higher than your MPC, which means that there will be a social cost, or in this case, external cost. And in this case, it will result in less social benefit. So we have to take the entirety of X minus Y to get the answer. So answer is B. Question 11. What would definitely result from the divorce of ownership and control? So ownership and control, basically management and also manager. So shareholders and the manager. So if let's say there's divorce, it will result in increased moral hazard, because basically managers, right, they have their own objectives, maybe to earn more money. Maybe shareholders wanted to control everything, including safety, including company terms of service, company rule of code of conduct. So there's to say that there's decreased moral hazard is not exactly the answer. B says the principal agent problem. Yes, that will happen because, like what I mentioned, managers and shareholders, they have different objectives. C, greater productive efficiency. Like what I mentioned, managers would have other objectives. So to say that there's greater productive efficiency is not really the answer. And D says increased profit maximization. This may be something that the shareholders may want, but not the manager. The manager may only want to care about increased revenue maximization. So they have different objectives. So answer here will have to be B. Question 12. One reason for market failure is the existence of public goods, and which policy option is appropriate for addressing such a market failure? So one reason for market failure is the existence of public goods, because these goods can be consumed by every single person without having them to pay. For example, road lights, which can be consumed by every single person, public roads, which is operated, everyone can use it without having to pay. For example, in Malaysia, federal roads, trunk roads, and then public goods, it can also be national defense. So these goods have to be directly provided by the government, because if let's say these are produced by private firms, they will be incurring a loss because they cannot earn from this. If you look at the three other options here, B says provision of detailed information to consumer. This one is provision of information / nudge theory. This one is for merry goods. So B is not the answer. And C says subsidizing firms that currently produce the good. Same goes to that, merry goods. And D says the adoption of maximum price controls. Regardless of whether or not you adopt a maximum price control or minimum price control, people cannot pay for it because there is no way to charge them. So you have to tax consumers, people who have income, tax them to actually produce the goods to the government. Only then you'll be able to provide these public goods. So answer is A. Question 13. In 2020, the government of California issued an order to ban the sale of new vehicles from 2035 that are powered by petrol or diesel fuel. And which type of government policy is this? This one would have to be regulation. Why? Because A says a nudge. Nudge basically means nudge theory, to ask people to change to electric cars. But here it says an order to ban, so this has to be a rule and there has to be rules and regulations. B says a permit to pollute. If it's a permit to pollute, then the sentence will go something like this. The government of California would issue a permit to people who pay a specific amount to actually use petrol or diesel fuel, which is a requirement. Then that will be a different story. C says nationalization, which basically just means to produce things within the country, but here nothing related to that. So it has to be D, regulation. Question 14, the diagram illustrates a monopsony labor market in which the government has imposed a minimum wage. And what is the difference between the wage the monopsonist wishes to pay and the wage received by labor? So the monopsonist here would only pay at the point where MRP equals to MCL. So MRP equals to MCL would have to be at point Q2, which is here and here. So the wage received by labor would have to be, you can see here, minimum wage is W2. And then the point where the monopsonists would pay would be at W1. Because that would be where monopsonists would actually maximize their pay rate. So here, the difference between the wage the monopsonists wishes to pay and the wage received would have to be the difference between the minimum wage and also the point where MCL equals to MRP. Therefore, the quantity where the MCL equals to MRP and also the ACL. So ACL here touches W1 and the minimum wage touches W2. So the difference would be W1 and W2. So answer is B. Question 15, economics textbooks state that labor is a derived demand for a firm in imperfect competition. And how is the demand curve for labor derived? That would be your MPP times your MR. So that would be this times this. Because that's how the demand curve for labor is derived. And so the answer would have to be D. Question 16, the diagram shows the Lorenz curves for Norway and India. What can be concluded from a comparison of the Lorenz curves? Okay, so you have to remember that this can also be used to calculate Gini coefficient. So if let's say the curve is larger, covers a larger area, that means it's more unequal. If it's completely straight, that means it's perfectly equal. Perfectly equal mostly have to be developed countries. If it's less equal, that would be developing countries. So you can see that for Norway, the area is slightly smaller than India. So A, it says India is more likely to have lower indirect taxes and a public sector education system than Norway. In this case, the answer is not correct because I'll explain to you why. The curve for India, Lorenz curve for India, is actually higher than Norway, which means it's less equal. In order to have a more equal Lorenz curve, you have to have lower indirect taxes and better public education system. But in this case, you see that the I, which is basically India, has a Lorenz curve with a larger area than Norway. So this means that it's more unequal, meaning that they have higher indirect taxes. So that's why A is incorrect. B says India is more likely to have a progressive income tax system and means lesser benefits than Norway, which is also incorrect because progressive income tax system means that you'll be perfectly equal, will be more equal because people who are richer will pay a higher rate of tax, whereas the people who are less well off will have to pay lower income tax. But you can see it's unequal, so it's less equal, so it's not the answer. C says Norway is more likely to have a progressive tax system and public sector pensions than India, which is correct because progressive tax system means people who are more well off will pay more taxes. Public sector pensions, meaning that people who have already retired will get amount of money to live, so the standards of living would then be better. And D says Norway is likely to have a higher percentage of tax generated from indirect taxes, which is incorrect. Like what I mentioned, you can see here Norway is more equal than India. So the higher percentage of tax which should be generated from direct taxes and publicly funded pensions. So it has to be C instead of all the other answers above. Question 17, a reason for government intervention in the workings of the economy is to attempt to correct a market failure. Sometimes though, government failure may occur. And what is not a possible reason for government failure? A possible reason for government failure would have to be based on these things: outdated information, difficult to judge, the extent of the externality, and also responsiveness. So let's say, for example, you are trying to correct a market failure due to whatever, maybe market mechanism. It will take years for it to become more stable. For example, inflation. In order to make it more stable, you need to take long run measures. So it will take time, and you may not be able to respond quickly because you need time to plan out what you need to do. So here we look at these four options and see which one will be the best answer. A says governments may have to make decisions on the basis of outdated information, which is correct. Information may be outdated because by the time the information reaches the government, they will have to take time to process, and when they take time to process, the information will probably be from months ago. So it may be no longer the same thing, maybe there will be changes. And B, governments may make decisions that reduce negative externalities. In this case, right, if they make decisions that reduce negative externalities, it will result in success instead of failure. But in this case, it results in failure, so that's not a possible reason for government failure. C says the extent of the market failure may be difficult to judge, which would result in government failure. Because let's say if you spend too much money, you end up getting less returns. If you end up spending less money, you get less returns. So it's very difficult to judge the market failure to let's say provide subsidies or to buy stocks and whatever. And D says when circumstances change, the government may be unable to respond quickly because it takes time to actually process these things in Parliament, for example. So answer is B. Sorry, B. Question 18, the government wishes to support growth in the economy's fishing industry, and which policy is likely to achieve sustainable growth in the fishing industry? So to achieve sustainable growth, it has to be supply side policy and not directly providing items. So A, it says giving more modern fishing boats with larger nets. So achieving sustainable growth by giving more modern fishing boats with larger nets is a short run measure. This is just directly providing things. B, it says paying bonus payments, which is also directly providing things, which is a demand side policy. And C, it says setting up a fish cooperative, which basically means oligopoly in this case. Like it's like a cartel, but it's not a cartel, it's like cooperative. So so you're setting up the cooperative so that you're receiving a higher price. This is not a long run measure, it's a short run measure. And D, it says subsidizing the building of a fish farm to encourage the workers who fish for a living to switch from sea fishing. Subsidizing the building of a fish farm, this would then have to be supply side policy because you're constructing new things that will help to improve infrastructure. Therefore, answer is B. Question 19, 4 citizens have each been unemployed for the past 6 months, and which citizen would not be characterized as being structurally unemployed? A, it says worked as a coal miner, but coal-fired power stations are now being closed and is not willing to retrain. This is structurally unemployed because of technological processes. So A is structurally unemployed. B, no longer works in a town center coffee shop because fewer people are buying goods in the town center since the pandemic. This is also structurally unemployed because people are switching over to online sales of online purchasing of food using providers like some online providers. C, cannot move with the firm that has relocated because of changing demands for its product. This is also structurally unemployed. D, it says has many skills and is waiting to decide which job might be the most suitable. This is fictional unemployment because you choose to be unemployed instead of being employed because you're still finding the best job for you. This is fictionally unemployed, not structurally unemployed. Question 20, in the diagram, OP is the equilibrium level of income and OQ is the full employment level of income in a closed economy. And what is the deflationary gap? So deflationary gap would have to be at a point where you are you're spending and also basically the difference between your income and also your spendings. So here we have to take the total income. This one in this case would have to be full employment level of income in a closed economy, which means there's no x minus m. So the maximum point will only have to be C plus I plus G. At this point, right, the highest point of income will be the point Q, and that will be a Q. And then for our income, that will be V, and then for our expenditure, that would be at U. So U would be at this point, and so the difference would have to be between V and U, which also means the answer is UV. Answer would have to be D. Question 21. What is the most effective policy a government could introduce to reduce frictional unemployment? Frictional unemployment is basically when people are frictionally unemployed because they are unemployed because they wanted to switch from one job to another. Okay, so A, it says cut welfare spendings on benefits, which is not going to help. D, it says raise interest rates. If you raise interest rates, then people will end up spending less. And C, it says reduce tax rates, which would result in less government, result in less income. In this case, right, frictional unemployment would have to be increasing the awareness of more job opportunities. So answer would have to be B, improve information about job vacancies. This one says B. Question 22. In a closed economy with no government sector, when will an increase in investment spending generate the largest increase in equilibrium national income with no government sector? So that will be when there's a high marginal propensity to consume. A, it says when households have a high level of autonomous consumption, that's when you have to consume regardless. And then B is we have to save regardless, so that's why both these are not the answer. So if you look at D, if it says high marginal propensity to save, which means that you save more, you have a tendency to save more instead of spending more. So that's why D is also not the answer. Instead, your increase in investment would also result in a high marginal propensity to consume, which would then kick in more national income, because when there's an increase in investment, people will also spend more money because of the fact that because basically your multiplier and your accelerator, they actually both reinforce each other, so it has to be high and also high for both of these things. So when you are willing to increase your investment and consumers are willing to spend more, this will generate the largest increase in the aggregate national income. Question 23, which combination of policies is most likely to increase output? Most likely to increase output, you will have to increase your budget deficit, which means increase expenditure. So A, B is incorrect. Okay, so then monetary policy means to decrease your interest rates, so answer is C. Why is it decrease interest rates? Because people will end up borrowing more to actually improve, to purchase more facilities to produce more of the same amount of goods. Right? 24, a country is a net importer of oil. World oil prices have risen over the year. Assuming that all other factors remain the same, how is this likely to affect inflation, trade balance, and unemployment in the country? So a country is a net importer of oil and world oil prices have increased. Your inflation would also have to increase because of the increase in the price level. Therefore, A and D are incorrect. Your trade balance would improve because your trade balance will worsen because now you are purchasing more. Your balance of trade will now worsen because you end up having to have a higher outflow of money than an inflow of money. And then your unemployment will also increase because now you have less money to allocate to actually companies that may need the money to actually produce more. So answer will have to be C. 25, what will reduce the effectiveness of a supply side stimulus to the economy? Reduce the effectiveness of supply side policy. So D says the relaxation of import controls, which is not really the answer, because if there's a relaxation of import controls, that means that there will be more raw materials that will enter the country from other countries. C says the provision of new training schemes, which would increase the effectiveness of supply side stimulus. And B says an increase in public sector spending. This one would result in more spending on the public sector, which would then improve education and so on and so forth. And A says an imposition of maximum hours, which will reduce the effectiveness of the supply side stimulus, because if you impose maximum hours, means that people will only work in that specific amount of hours, and you'll churn in lesser quantity. So if you compare A to D, the worst one will have to be A, because the relaxation of import controls would then result in an increase in import of raw materials into the country, which would help to improve infrastructure because you're paying more for imports. If you compare to A, right, that would be less production. So even if you have raw materials but there's no production, you'll not be able to produce the product. So the best answer here would be A. Question 26, a multinational company shifts its manufacturing capacity to a developing country, and what is likely to be the short-run effect of this in the developing country? So it's shifting its manufacturing capacity to a developing country, meaning that it will hire more workers, so A and B is incorrect. And then your investment will have to increase, but that doesn't necessarily mean that your balance of payment current account will improve in that country, because there may be more outflow money, maybe more money is flowing back into that country. Because you have to see here that multinational company is shifting its capacity to a developing country, so more money will end up being sent out of the country instead of leaving it inside. But definitely your employment and investment will increase in that country because of improved infrastructure and also job opportunities. Question 27, to indicate the changing income distribution, the Kuznets curve plots gross domestic product per capita against an economic variable X. Your economic variable X here would have to be the level of income inequality, because your Kuznets curve is designed to determine the level of income inequality in that particular country. So answer is B. Question 28, economists define the unemployed as being those who are not in work but are actively seeking work. Other groups of people in the population of working age include those classed as inactive or self-employed. and which groups of people are included as part of a country's labor force. So labor force meaning that people who are ready for work. Unemployed means basically yes, but then inactive is no, because people who are inactive are not part of the labor force because they are not actively seeking for work. So self-employed are also part of the labor force, so answer will have to be B. The reason why inactive is not part of the labor force is because they are not ready for work, they don't want to work, so they are not going to contribute to the country's improvement in the income and also the economy. Unemployed people are considered because unemployed people, they may or may not be ready for work, but they are indeed seeking for work, because unemployed people are people who just have no jobs. But inactive people definitely no, and self-employed people yes, because they are working, but they just work, but they employ themselves basically. Question 29, the table shows some United Nations population statistics for 2010 and estimates for 2050, and which relationship can be confirmed from the table. So it says the least developed regions have the largest urban population actual predicted in both years. So least developed regions have an urban population of 249, 940. If you compare the other two on top, it's definitely not the answer. So A is incorrect. B, it says the more developed regions have the lowest rate of urbanization between 2010 and 2050. So more developed region, you will see that for population urbanized, for more developed region is actually 11%. For less developed, there will be 21%. There will be 21%. That will be 21%, and then for least developed, that would be 26%. So I'm just gonna write that down. So B is the answer, but let's look at the two other options here. C says the type of region with the greatest total population in 2010 is predicted to have the greatest rate of population growth by 2050. So you can see here, for more developed region, it has the least population growth, total population, because you see it only increases by 38, and then 38 million. For less developed, it increases by 2,204, and then for the least developed, it increases by around 818 million people. So that is more than that's almost double of the total population in 2010. But if compared to the other two on top, it's definitely higher. So the type of region with the greatest total population in 2010, which is less developed, is not predicted to have the greatest rate of population growth. It has to be the least developed region. And then D says the type of region with the greatest urban population in 2010 is predicted to have the highest level of urbanization by 2050. The type of region with the greatest urban population is the less developed region, but you can see the highest level of urbanization is actually not the less developed region, right? So because you can see that the highest level of urbanization would have to be the ones with the higher level of urbanization is the more developed and the least developed regions. So D is not the answer. Answer has to be B. Question 30, the diagram shows the Lorenz curve with two areas, x and y identified, and how is the corresponding Gini coefficient calculated? So you take the area between the line of perfect equality and the Lorenz curve, and you divide it by the total half of this entire triangle here. So it has to be x divided by x plus y to get your Gini coefficient, because that's when your area divided by total area would give you the answer for this Gini coefficient. Because Gini coefficient will always only be from 0 to 1. So answer here would have to be A. Alright, so I hope that, so this is the end of this video. I hope this video has helped help you guys out with economics A2 level, May, June 2023, paper 31 and paper 33. Do share this video out to other people who may need help with economics A2 level, and do comment down below on whether or not this video is much better compared to the previous one. I hope to see you guys again in the next video. Till then, this is qiphyedu. Goodbye.